Because understanding international trade is important both economically and politically, we want to think about how to extend our supply and demand diagram in order to incorporate imports from and exports to other countries. Not surprisingly, countries are going to want to import or buy foreign-produced goods when there's a profit motive to do so. In this case, the profit motive comes when the world price, or the price at which goods can be bought on the world market, is lower than the price that would prevail in the absence of trade when the economy has to rely entirely on its own domestic supply. So we can see how to graph that here. You'll notice that you have a supply curve that looks like the normal supply curve that we've talked about earlier, but I've labeled that S sub DOM for domestic. So this is going to be our supply from domestic producers, or producers in the home country. Similarly, we have a demand curve that looks like our normal demand curve that I've labeled D sub DOM for domestic demand. And that's just the demand from consumers in the home country. And then we can see, just as we had before, the price, the equilibrium price that would prevail in the absence of trade, if we only had domestic supply and demand, is just going to be at the intersection here, and I've labeled that P star sub NT for no trade. The addition that we put in when we start talking about international trade is this line here, which we're referring to as the world price. And we can see, just as we said in words, that we're going to want to import when the world price is below the price that would prevail if there were no trade, which is this price here. So what we're going to see is we're going to want to import whenever WP, the world price, sometimes referred to as P star sub W for world price, is going to be less than our no trade price. The intuition behind when a country is going to want to import versus produce domestically is, of course, that people are going to want to buy things that are cheaper. So if we see that we can buy things more cheaply at the world price on world markets, we're going to choose to do that rather than to buy things more expensively by relying on our own domestic supply. In addition, a country is going to want to export or sell domestically produced goods to foreign countries when there's a profit motive to do so also. This profit motive, conversely, comes when the world price, or the price at which domestic producers can sell the good on the world market, is higher than the price that would prevail in the absence of trade when the economy has to rely entirely on its own domestic demand. So we can see here, again, we have our basic, what we saw before, our supply and demand diagram, where we have our domestic demand and our domestic supply. But now we've placed the world price at a price higher than what we would see if we had an economy that wasn't trading with other countries. And you would just see that that would be at the intersection of domestic supply and demand, and that's what we've labeled P star sub NT here. But now the world price is higher than that, and we can think about the world price now as the price that these domestic producers can sell their stuff at. So basically we're saying here that domestic producers are going to want to sell to other countries when they can get a higher price by doing so than they could if the country was closed off to trade. There are a couple of things that are helpful to clarify here. First, you may have noticed that when we were talking about the world price when we were importing, we were talking about the world price as the price that we could buy on world markets at. Whereas when we were talking about exports, the world price became the price that we could sell on world markets at. So that makes the world price in context here seem like one of two different things. But actually, if you think about the way markets work, the price that you could buy something on a market at and the price that you could sell it on a market at should logically be the same price. So even though it seems like we're talking about two different things when we mention the world price here and we mention the world price here, they actually have the same interpretation. In fact, if you really wanted to, you could even think about this world price line when we're importing as the supply of imports available to an economy. And you can see here that we've modeled the supply of imports as perfectly elastic, implying that this country, under certain assumptions, would be able to import as much as they wanted at the world price. You could also label the world price line in this context where we're exporting things as the demand for exports. Notice I've called that D sub EXP for exports here, whereas here we talked about S sub IMP for the supply of imports. And here when we're talking about the demand for the exports, what we really mean is that under certain assumptions, this country is facing perfectly elastic demand for its product, meaning that this country faces basically unlimited demand as long as it's willing to sell at this world price. That it can't sell at anything above the world price, but it can sell as much as it wants to at said price. The other thing that's helpful to note is how this all relates back to the concept of comparative advantage that we talked about earlier. As you recall, comparative advantage is just the ability of one country to be able to produce at lower opportunity costs than other countries. So we can think about here, when we're looking at the world price versus the domestic supply curve, what we're really doing is we're comparing costs of production. Because we said before that the supply curve in a competitive market represents marginal costs. So it then makes sense that the world price would also be representing the cost of producing in other countries. So we can see here that when the world price is below the price that would prevail in the absence of trade, we can roughly say that this is when other countries have a comparative advantage in producing this good. Whereas over here, when the world price is actually above the equilibrium price that would prevail in the absence of trade here, we can say that this domestic country has a comparative advantage in producing this good, that it can do so, roughly speaking, at lower opportunity costs. And we said before that it's efficient for a country to specialize in that good where they have a comparative advantage and then to export that good to other countries. And that's what we're seeing here is actually happening because of that explicit profit motive. That when a country doesn't have the comparative advantage, it has an incentive to import, and that when a country does have comparative advantage, it has the incentive to export.